Good morning, everybody. Welcome to the Flow Show. Hope you're doing well this fine Wednesday. Lots going on in dollar yen, so please excuse me. I'm going to have one eye on my trading screen probably through this show because I'm in a bit of dollar yen on the back of all these comments this morning. So if they go a bit quiet and probably you hear a lot of clicking, it's probably because I'm trying to trade out or trade around this position. But anyway, we shall get on as best we can. China's President Xi hopes for more exchanges between China and the US. Comments made there, China State TV. So still looking to potentially improve relations, though they keep finding themselves under various sanctions and chip sanctions and all the rest of it. So there's still a long way to go on that front. Right, Bank of Japan, let's get straight into that lot. We've had the Ueda out and one of the board members, Tamura. Tamura said that future monetary policy guidance is very important to ensure the BOJ moves slowly but steadily towards policy normalization. Says in his view, the BOJ's ultimate goal is to bring interest rates back to levels where hikes and cuts are made to adjust to demand and affect inflation. That's how monetary policy should work in most normal countries. Japan has been normal for some time, as we know. It says the impact of FX moves on the economy vary depending on each entity. Now, you know that the BOJ has made FX moves part of their thinking in terms of policy and its effects on the economy. That's a bit of an additional step in their ballpark, if you like. The level of the yen and FX moves are down to the Ministry of Finance, but the BOJ are now taking that into consideration more with monetary policy, it seems, than they did previously. It went on to say that if the economy weakens, we will conduct appropriate monetary policy as needed, including negative rates and YCC. So the toolbox is not had the padlock put on it just yet. Says there is no set formula when asked about additional rate hikes. The head man was up as well, Ueda, saying nominal wages are to pick up, real wages are to turn positive, sees the positive wage inflation cycle strengthening, and the growth in real wages is likely to gradually turn positive. Says Japanese household sentiment indices are improving recently on expectations of wage hikes. It says revised GDP and wage results played big roles in the March move on monetary policy. All the government lot are coming out now speaking about FX. Chief Cabinet Secretary Hayashi said rapid moves in FX are undesirable. Suzuki, same old waffle, closely watching FX moves with a high sense of urgency. And then this morning, we got the wires pumping a trilateral meeting between the BOJ, F.A.C.E, it's the securities agency, and the MOF. Big red headlines, meeting of all these three guys. These meetings, as I pointed out in our chat room, are, well, I say regular. They can hold them twice a year or as they see fit. So there's nothing emergency about these meetings. They do hold these meetings. They talk about markets, financial conditions, so on and so forth. But as we're in heavy intervention watch and all things going on with Japan, the wires decided to pump it, big red headlines, make it seem like it was some sort of emergency meeting. Kanda came out from that meeting pretty much with a lot of the same old lines. He said that they discussed various financial matters, so on and so forth, then trotted out the old jawboning line. But it has, to me, it seems like it's just stepped up, but it's a bit more forceful from Kanda, the moves. One of the key lines being that he said they are clearly seeing speculative moves. That's a bit different to won't tolerate speculative moves. So talking about things that are happening now, they're seeing speculative move rather than the prospect of speculative moves happening. He also said that 4% FX moves in 2 weeks are not moderate. I'm not sure what he was going to expect when the BOJ finally started changing decades of monetary policy the other way, but there you go. 4% is, they should be probably take that with both arms. Anyway, the candidate comments are, to me, feeling a bit more forceful. So I think we are really getting to a point now where intervention risk is really, really high at the moment. We've obviously seen this move in dollar yen. It's continuing to drip lower, just making fresh lows as I talk here. I did start fading this move into 151 when we started getting those talks about the meeting, because, as I say, these meetings aren't anything that's an emergency. They haven't just been brought out because of the moves in FX. They hold these meetings when they want to. But it has changed the mood, as you can see. Yen's bid, the market a bit more reluctant to have a crack at another crack at that 152 handle, which we did again overnight or late last night. We had a move up to 151.97. That's the highest it's been in all those tests that we had. So still 3 pips short of the big figure. And now it's been slapped down again. So the market's probably just taken a little bit of caution from these comments coming out of Japan. Maybe we struggle to get back up towards 152, but we'll see what happens with the dollar as the US folks come to the party, as they like to do. See whether they start picking it up as well. But yeah, a little bit of wobbles put in the yen for now. On the other side of things, apparently Japanese banks are poised to increase their cutting of some 65 billion in stocks that they keep on the books. I haven't read the full story because I can't actually find an open link to it. But anyway, it's some of this is to do with a lot of stocks that they sit on. They've been sitting on for donkey's years, Japanese stocks in the main, but they have been slowly cutting those holdings, and they may be looking to cut more. But if I find out anything more on that, I'll drop it in the chat room. Over to some data. We had Aussie CPI data out, which was nothing much at all in the end. The data, if I can find it, there we go, the weighted mean CPI. So this is the new series of monthly numbers that they started, I think, last December, something like that. Anyway, was expected to go up a pip, stayed unchanged. Nothing to see here. Move along. No, it doesn't change the mood for the RBA any way, shape or form. Over in Spain, we had flash CPI numbers for March. Their 2 handle is now back to being a 3 handle. Was expected to see inflation bouncing here. The Eurozone measure didn't jump as high as 3.3, got to 3.2. CPI did, though, beat expectations by a pip. Their core number as well, which is it on there? No, can't remember. Let me have a look. Their CPI core came in a little bit softer than expectations at 3.3, was expected at 3.4. Last month was 3.5. So their CPI core number came in a little bit softer. ECB's Stornoas is joining the no shit Sherlock movement. Seems there is a consensus for a June rate cut. I don't know why it says it seems there is a consensus. He's on the bloody board. He should know what the consensus is. Anyway, Kestrel Kazakhs is all moving round to a June cut as well. Says inflation is slowing and a first rate cut is nearing. Says he doesn't object to the market view of a June rate cut. So it's getting to the point, or it's at the point now, where if they don't cut in June, that'll be the big price risk. Everyone's now thinking that they're going to cut in June. There should be little price move on the confirmation, but as I say, the balance of risks for the price is if they don't cut in June, or indeed if they surprise with an earlier cut. We'll see. Don't think that's going to happen. Riksbank, they left rates unchanged, but says it's likely the policy rate can be cut in May or June if inflation prospects remain favourable. Governor Thielen came out afterwards saying that it's a 50% probability of a May cut. So it's a 50-50 bet of whether they cut in May. Coming into the data from yesterday, fairly chunky data coming out. We had those durable goods numbers, which did show a decent improvement in the headline numbers. Headline durable goods rising 1.4%. Even the core durable goods up 0.5%. The capital goods orders non-defence ex-air number as well, which is an important number, came in at 0.7%. So on the face of it, decent numbers, green numbers. However, as I was telling you in the run-up, I've been looking at some of the more consumer-related items, and those weren't as good. Computers and electrical products, and I can actually show you on the data what I'm talking about. So these ones here, this is all sort of related more to the consumer side of things, like appliances, electrical equipment, computers, communications, phones, that sort of thing. 3 negatives and 1 positive. So that goes into my little pot of worries for the US consumer. Now, I should add, as you can see here, if you look at the other periods, they've been a bit up and down. So there's no real trend in these numbers, but I'm taking this for what it means this period. In this period, Jan-Feb, we've seen retail sales coming in softer for 2 months running. We've seen consumer sentiment numbers coming in softer. We saw that again yesterday as well. So these little warnings are just building up. This is what I look for when I'm looking to potentially trade trends. We're starting to see a little trend forming at the moment of a weaker consumer. Now, the caveat for that is that it doesn't mean I'm expecting the consumer to fall off a cliff. This could just be some normal softening. Could still be just some fallout from the positive numbers we saw into the end of the year, just washing out a bit into the new year. So, I'm not jumping up and saying sell the dollar and put your house on it. I'm just saying I'm seeing things moving in a particular direction. What I'll watch for is if that continues and the speed or not of which it picks up or doesn't. If it picks up markedly, then I'm going to be thinking about seeing a more dovish Fed turning up than the market expects, and that's what will guide my trading. But at the moment, it's still early days, so I'm watching, waiting. But if you pick up these little signals, this is where it gives you the opportunity to get into trades early. I see a couple more prints coming in like that. Then I'm seriously going to think about shorting the dollar in certain pairs where I haven't already got exposure. And then that's something I'll look to sit on for a while, because, as I say, it could lead that the Fed will be more dovish than the markets expect, and there'll be a trade in that. So anyway, that's my little cooking pot simmering away there with those bits and bobs. We also got Philly Fed non-manufacturing or services index that is never on any calendar. That came in far more soggy at minus 18.8. Let's see if it's actually on this one. They bothered to put it on? Nope. Okay, so you have to take my word for it. So that came in minus 18.3 from minus 8.8, so far worse. New orders slightly less negative at minus 3.9 from minus 4.7. In the inflation numbers, prices paid dipped a bit to 26.6 from 30.3, but prices received, that's how much people are charging, jumped to 16.3 from 2.0. So there's still sticky inflation there. Prices may be falling on the inputs, but on how much people are charging afterwards, that's going up. Employment, that came in at 3.5 from 9.1, so a little bit softer there. Obviously, we've got the NFP next week. Wages and benefits came in higher at 35.3 versus 34.4, so still some wage pressures on that one. House price data as well came in from the F.A.C.E and the Case-Shiller. Nothing much to see here. Prices still ticking along. 6% year on year, was a bit softer in the FHFA number at 6.3, but the national number in the Case-Shiller went up a tiny bit to 6.03 from 5.57% year on year. So national prices, these are the 20 major city prices. So there's a bit of difference, as you can see there. Still quite hot year on year, 6.6%. So nothing to worry about there in the house price front. as said, we've got the consumer confidence numbers from the conference board as well, and another soggy number, 104.7, so lower than expectations. The 106.7 from last month got revised down to 104.8. So now we have got a little trend going on in these consumer confidence numbers. Current conditions, though, were a bit better, 151 versus 147 previously. Expectations dipped 73.8 versus 79.8. Those 1 year inflation expectations came in at 5.3, so higher than the 5.2 last month. So still stickiness seen there. But as you can see, we have coming into the new year, we are seeing a bit of a we've seen a couple of reports lower. We had this, as I said, this nice move up into the latter part of the year. Now it's just fading off a bit. Nothing's collapsing. Okay, we're not seeing a big drop like in 2020 coming from 130s, 140s all the way down to sub 100. It's nothing like that. So this might just be a bit of going sideways. But let's see what trend develops. It's still another negative number. Bank of Canada's Rogers was out, mainly speaking on financial stability and other bits and bobs rather than monetary policy. But she did say more recently they've heard from firms that say that current interest rate environment is making financing more difficult. So firms feeling the heat from those higher rates, but then added that said, investment levels were also weak in the pre-pandemic years when rates were much lower than today. So she's also sort of counteracting her own argument about higher rates by saying, well, investment wasn't that great when rates were lower pre-pandemic anyway. Otherwise, not much else to say from her. That's it on the headline front. K-Man is not here today, so I can't ask him for anything, but I'll ask you guys if you've seen any headlines that you want to discuss. Chuck it in the chat function here on Zoom. Right, so let's have a look what's going on in this bloody dollar yen. So as I said, we've had another tap up here at 151.97. I'm really struggling not to trade this level up here. As I mentioned in the chat room, it looks tempting both for trying to short it and trying to trade a break, but I really am trying to sit on my hands because I don't like the risk that's involved at the moment. If I had to pick a side, I would say that we're probably far closer to intervention than we were yesterday or the days before. So as I'm sitting here long at the moment, I'm very careful, very cautious. I want to get a decent bounce, and if I see, as I said in the room, if I see 150s, I'll throw this trade out, or pretty much most of the trade out, and then go back to sitting on my hands. Maybe just keep a piece on for interest. But you've got to know we have got high risk at the moment if you trade in yen pairs. So don't be complacent. Don't be piling into trades in big size with 20, 30 pip stops, going long. You might make money, but you face a big risk of getting slammed on an intervention. And likewise, shorts. I've heard this morning from some of my contacts that, with stuff we probably can already assume, there's big stops sitting through 152. It's not going to be any news that we don't already know or think about. So it's still, for me, it's all about the volatility of it. It's all about the risks surrounding it, which is getting me just sitting on my hands. Even if I miss out on an intervention move by not being short and it moves 300, 400 pips, I don't care. I don't care if I miss out on something. If something's too high a risk for my risk parameters to trade it, then I won't trade it, even if it means missing out. I'd rather protect my account and miss out than get involved, be wrong, and lose a whole chunk of money just because they decided to smash it with a hammer or break 152. So that's just the way I assign risk to my trading. That's the way I do it. Otherwise, I haven't really looked at much else. There's not been anything else going on anywhere in particular. Euro dollar's looking a bit weak again. I mentioned that the bounce was looking a bit dead cattish in quite a few pairs. And it's still looking a bit dead cattish. We looked like we were mooching up. We took 2 days to move from there to there, and then we've taken half a day to move all the way back down again. So we're mincing around this zone at the moment. It's becoming a bit wishy-washy. You can't really trust it down the downside, and you might be able to trust it on the upside, but it's more. This is more now of a pivot line. It's quite wide, but it's a pivot line. If we're up and holding above here, then things are looking more bullish. If we're down here holding below, then things are looking a bit more bearish. But in here, it can do what it wants. But we are starting to see a series of lower lows, lower highs coming in. So it could be that we're going to be on for another test of 108. And you know what I say, if we have another test not too long after the first one, there's a higher risk that we have a break, and then we'll be looking to see where it wants to go underneath. So it's not out the woods just yet, but if it's another solid hold here, I would expect us to have a little mooch up again to 109 area. See what it wants to do from there. Cable as well. Again, not an awful lot to talk about. Had a little move under 126, moved back up again, and now it's just waffling about. So taking no notes from here. We're sort of holding 126 again, but as per last week, it's shown that it can carve through that level pretty easily. So nothing for me in here. Just watch the edges, see what goes on. You can tell that also what's going on in euro, dollar, and cable by what's going on in euro sterling, which again is not doing an awful lot. Though we are holding this 60s, 70s area, so it's still looking a bit more constructive than it was when it was in this box. I was saying unless we move above 85.70, it keeps the 85 level in play. It's still in play, but it's less in play than it was if we were below 85.70. Of course, 86, 86.10, 86.20 is the area we've still got to get above if we're going to do anything on that side. Marcus, you like to sit on your hands as well. Yeah, got to do it, mate. There's sometimes you get real FOMO, and there's sometimes you really want to trade something, and then it really becomes a personal battle with yourself, whether you sit on your hands or not. Richard asking about nat gas. Talking about the rollovers and where you get entered and exited. Depends on how it's done at your broker, whether you're trading a rolling contract or if you're trading a futures contract. Futures contract, you should be put out at the settlement price and then re-entered at the new contract month, and that's part and parcel of rollovers. You get the trade closed off and reopened at a different price. That's what happens in futures markets. So if that's the case, you have to really wear it. There's not a lot you can do. The only thing you can really do when you're facing rollovers is you can trade out the position before you get to expiry. So if it's favourable conditions, but that's where spread trading comes in, which is something I did a lot when I was trading futures on the floor. You do a bit of spread trading between the months. But some firms can make adjustments to the price, so you're entered pretty much where you were, but it really depends on what your broker does with it. But there is obviously the risk that you get closed off at the closing price, settlement price, and reopened at the new market price. And if there's a big difference in that, then unfortunately you have to wear it. But it just means you take the loss, but you still got the same position if you like, but that position then you continue on. So if the price was lower, depending on which side you were sitting, then you're obviously going to get entered at a better price. If the future month was lower price than you were in already, you're going to take the profit. So it's a bit swings and roundabouts on that one, but that's you're just worried about the price close. That's a difference. Again, there's nothing you can do about that. That's futures trading. It should be the settlement price or the closing price should be pretty close to the market price. Okay, so you shouldn't you know, if NatGex closes, I don't know, whatever it is, $2, and the next futures months is $2.10, then you should get closed out at $2, and then reopened at $2.10. Obviously, compared to what your position is, you can only get closed out at that. So, yeah, I don't think I'm sounding too clear, but I know what I'm talking about in my head, even if I'm not explaining it clearly. But yeah, unfortunately that's futures trading for you. Right, let's have a look around the grounds. Another pair that I'm keeping a keen eye on and I'm getting a bit twitchy over is dollar MEX. Oh, it's nearly got down to my stop level here. This one has been knocking along this support line for quite some time, and now it looks like it's breaking lower. I think we may. I'm not sure if he's going to be a fast runner if we get a break, but looking at the price action at the moment, you know, we had these lows. It was holding pretty well. We're now below those lows, and now we're holding below those lows. So I don't know if this one's going to crap the bed or if it's just going to bleed lower. But I'm in with some stop reverses at 1661. I'm still long a bit, so don't know what to do here. I might just throw the trade and see what it wants to do and keep the stops rather than lose a bit more on this one. But it is looking generally weaker in this pair. Let's see what's happening in Euro MEX. I've got a lot of text on that, but yeah, this one keeps going lower as well. So definite MEX bid going into this one. We are looking at some much longer term levels if this does go here. You know, we're talking maybe, whoop, let's just zoom it in a bit, make it a bit clearer. Not that clearer. So talking down in the 1630s, perhaps as the next decent support point, that traffic area going back to 2015. So yeah, there's this has the potential for a bit of a move if we get through here. It's been down here a few times, been down here a while. 2023 we were here, 2024 we're here. Now it's looking like it's breaking. So no signs of giving up for this carry trade at least. Ali, let's see what you've been up to today. Took a position in Euro Sterling. So you're long Euro Sterling at 69. Take profit at 99. So you're pretty much trading that level here, this 70 area. Oh, let's go in, come in again. So trading along that line, which is fair enough. Fairly tight. Well, yeah, stop. You got 40 pips on that stop. I think. Don't know. Maybe think about whether you want to stretch that far. You know, as usual, I can't tell you how to trade, but we know we've had a lot of traffic in this 50 area. But yeah, 29 sticks you under this traffic level as well, so it gives you a bit of room. 99, fair enough. So you're risking 40 to make 30. Again, that's a bit of a skew the wrong way on your risk reward parameters, but you know how to trade, my friend. So you don't need me to tell you what to do. Gavin, Euromex 1750. Yeah, I've not got a lot of tech on my Euromex. It's not one I look at a lot. As you can see, that fib is in the middle of nowhere. Don't know why it's in the middle of nowhere. That's because it's that leg there. So not that it matters anyway, because we're nowhere near getting up to the 38.2. So I might as well get rid of that. Yeah, so you've got some levels, 17.5 down there, which is what you've got, weekly levels. Yeah, just along those, the bottom of those two candles there. So yeah, I see that. And then we've got some traffic down here into the low 16s, 15s and a halves down there as well, just as an outside. And let's have a look at this fib here quickly. Let's see if I can do it without fucking it up. Let's take it from the proper swing. Yeah, to there. I'll tighten that up, but yeah, this 1780s is the 50 fib of that move, so that's potentially another support point to look at in this. Oh, bloody hell. Get in there. Right, there we go, a bit clearer. So yeah, big old fib, this one. 50 fibs, 70 80s. As I say, I'll tighten the numbers up in a little bit. So that's your consideration first and foremost there. I do like the big fibs if they work, especially over many years. You know, the longer the fib is, the more strength I assign to it in terms of potentially trading it. I haven't even got me moving averages up. Look at me. Thought I was missing something. So not a lot there on the monthly. Let's have a look on the weekly. No, weekly is all above. And the daily is all going to be above as well. So, yeah, looks like if you want to be looking for shorts, up here in this little confluence of MAs is where you want to be potentially doing it. So, starting from the 55, then you got close confluence there in the 60s for the 200 and the 100 moving average as well. So there's something for rally sellers there as well. Dollar China. That's still keeping it's not going all the way back down to here. So no real bigger headlines out of China. I haven't heard that they were intervening overnight in this one. I might miss the headline, I don't know, but certainly no big effects now. So we've got a couple of daily candles that are looking a little bit quieter, which that shows that the market is taking note of the move we had there. Those guys in China hitting it up in the 728s, so the market a little less conviction in trying to take them on again, but it's not dropping all the way back. What have you got coming up today? I don't think we've got an awful lot coming up today, being Wednesday in the US. Let's have a look on the data front. No, absolutely naffle coming up on the data front. We do have 7-year auction coming up. We've got some fairly decent supply coming in. A lot of the market is focusing on this Wallace speech later. He has had a tendency to say things that have been market moving of late. So his words carry a lot of weight, and the markets are citing this as a bit of a risk event later tonight. I might be around for it if I'm doing the options, but keep an eye on that one. It's going to be coming right on the roll time for brokers, which isn't the best time to try and be trading. So watch your spreads and stuff over that if it does say something big, but that could be a mover for the dollar as well. Right, come boys and girls, give me some prices in there if you something you want to look at. If you want me to look at something, just want to go through a few things. Ali, do I trade options? Yes, I can do. On occasion, I have. Depends on the circumstance. If there's a big event or something like that, and the options are cheap enough to trade a view or a bias or something I think is going to happen, then that's something I'll look at. K-Man trades them more actively than I do. I don't do all the hedging around and all that sort of palaver. I just trade them pure vanilla as a directional move or coverage for something, hedging some trades in spot or anything else. But again, I had a conversation with our mate Horatio, who's in our chat room, just about volatility and stuff, and looking at the vols and how you assign those vols. So for those who are in the chat room, you can have a look at that. Of course, Derej, I'll have a look at gold, and then I'll look at dollar CAD, Michael. No problem at all. Let's go and have a look at gold. There we go. So it's still holding the line, 40-50s or 45s, 50s, whatever you want to call it. That's we've been talking about that for a while. It is looking more bullish. Take out this spike, which, as I said, looks a bit similar to that spike we got over there. We've had a big move. We're holding support around here. We're just creeping up with some higher lows. And as I say, take out that, we've also got some high highs coming in. This will, despite this being something you want to half ignore, it will be important if we get up there and we find its resistance again. That will show something is definitely up there. But it's creeping. We had a move to 22, and that was resistance yesterday. We're having a little butchers up here now. again, I'm not sure what is driving this. It feels like it's risk. Again, you know, we're seeing stock markets, we're seeing stock markets coming off. So maybe there's just some risk going on around. There has been a lot of chat over this bridge stuff in the US, of course, and its potential economic effects. I think a lot of those are overblown, you know, potential inflationary impact, that sort of thing. So if there's any sort of risk element of that new story in this, I think it's the wrong way to look at it. But yeah, for all intents and purposes, this looks like it wants to keep going up. So, you know, where your levels are, 2200, your first level, and then you keep an eye on this high just in case there's something more up there. If it goes past that high, then you know, without blinking, then we're off to the races again. And where it goes from there is anyone's guess. A bit similar to the S&P, where you just have to wait for the price action to develop and see what it wants to do. So Michael wants to look at dollar CAD, which is still knocking around this 136 area. It's really, I'm pretty much going to just keep it to the fib, I think, because, you know, 136 itself, we've been above it, 5s, 10s, 15s, 17s, whatever. So I'm gonna call it this fib area. That's the level we need to get above. But then just above that, we've got that 136.50. Dips are being bought up pretty quickly. Again, though, this is on and off with the oil correlation. On a fundamental basis, yeah, the Canadian economy is ticking along. There is no reason why this should make a real move one way or another. The market's happy with where the Bank of Canada's at. You know, there's no real problems in the economy. As I say, this switches on and off with the oil trade, so it's not really following that. I know there's a lot of people quite bearish on the CAD. I don't know. I think, you know, look at this range here. We're bang in the middle. It's consolidating. It doesn't know what it wants to do, but it's giving you a decent range to trade. You know, 135s, mid to low 134s, and you can give it a crack up here at in these 136s if you fancy being short. But again, we're up here far too often for my liking. So it feels like at some point we're going to get a break. The price action showing that it's looking like it wants to move higher. How high that goes, I don't know. If you get over this lump and run into 135, 136.50, and it bangs its head there, then you're probably going to see another move down to 135.5, and maybe that was just an extension. Clean out a few stops, stretch your legs a bit, and then we stay back in range. But even so, it's just, there's a real gradual uptrend in here. So, you know, again, that also leads to point to the fact that we might be looking for higher levels. You know, let's just draw a couple of trend lines in that just so you can see. So roughly like that, you can see this uptrend going on. Some might be thinking it's a flag or whatever they want to call it, but this is the trend, and it's just creeping up, and that's what dollar CAD can do. It can just creep up on you. So if it follows this channel, then all well and good. We're going to be moving higher. What are you thinking about it, Michael? You got any particular thoughts or bias about this one? You long, you short? You've got some levels in mind that you want to play up with this one? Hannah, you're in everything, mate, aren't you? You're in gold now as well. Long at 92, stop loss at 76. Okay, so you're long right up at the highs. Okie doke. I'll let you play that one. Long from 38.2. Got this one here, 133.5, 134.5. That's a very nice trade, mate. I hope you get a nice decent break of 136 in that case. Right, I don't know what else to look at. Aussie dollar, as I said, that CPI data was a big of a nothing in the end. So here we are, a bit like euro dollar, just mooching around this old zone. It's not really doing anything above or below it. So again, I'm not going to concentrate too much on the numbers. It's more, are we above this zone? Are we below the zone? Use it more as a pivot point. We'll have a look at a couple of crosses because I know you guys and girls, particularly, I think Richard likes to trade Euro Aussie. Let's see what's going on in that one. Again, ranges. That's all we seem to be doing at the moment, which is part and parcel of, markets that are pretty okay with where they're at with things. No big differences. Everyone knows what economies are doing. There's no big surprises coming up. So we're seeing consolidation, and that's good because you can trade these ranges. You can be a buyer 164.5. You can be a seller 167s, or you can pivot around 166. Nice ranges, nice trading ranges. If you get them, if it's quiet, then you can chip away, putting those pips in the bank just by making some nice range plays going on there. Quick look at stocks, because I had noted that this one has been, S&P has been bleeding lower a bit. Where shall I go? It's going to the hour. So yesterday I was talking, watch for any moves up to this area here, see if it resists, and lo and behold, it resisted, and then we went on to break that prior low. So we broke that low. Now we're holding that low, so I'm going to stick a line in there. I haven't updated this chart for a while, so I'm going to stick a line in there now, because for me, this area, let's call it that area there, 52.20 is a bit of a level now. So again, this is short term, so it's just short term price watching. I'm not going to rely on it, but I want to see, if we get multiple tests here, then we know what to do. So we've had this bounce. So we've got this downtrend happening since this high. That's first and foremost. Pretty much lower highs, lower lows. Now we see what this bounce wants to do. If it fails around here and then heads down, it'll probably go through this 20. If it makes a new low, then we're just starting to see a bit of a downtrend that's lasting more than a couple of days. The last time we saw something like that was here. Similar price action. We had a high then, we couldn't do much, and we just bled lower. Does it mean we're collapsing? No. What we did is we got to the big support point, and that's where we bounced. And then off we went again, and off we went again, and off we went again. So as I keep saying, it's all about price patterns. You get these repeating price patterns. It gives you an idea how to trade it. The difference here, though, is this is still pretty no man's land. So if this pattern's going to continue, we bleed lower, the big test will be when we get here. If it bounces from there, then we might get a similar situation to here, where we then go on and make new highs. Or we come all the way back up, we hit this level, or this level, and we mark a top again, and we find the resistance too strong. Then we're getting into this sort of scenario where now we've had two confirmed tops over a reasonable period of time. Does it mean it's going to collapse all the way down to 5,000? No, it's still got to get through the support levels. But again, we've got evidence to say that we've got a bit more of a top up here. Is it going to be a 2-3 day top like this, or is it going to be something more significant? If we got a third top made up there, then that's the time where I'll be thinking, hang on, something's changing now. We're now not going higher anymore. That's when you can really start to maybe think about some shorts that will start taking out some of these support points. So from here, still about price watching. Just watch these levels. I've got no conviction trading here unless my conviction is trading a hold down here or trading another break up through these highs. If I was to look at that, I'm still obviously long a bit. Juicy would be a move down to here, that support area, to get back into longs. But yeah, still need to see some evidence coming up here. Yeah, Michael, 135.50. Okay, yeah, that one. Cool. Well, it's still good. Still a good trade, mate. So hope you make plenty of pips on that. But yeah, stocks, similar pattern here and here. So you saw what it did here. See if it does the same thing here as well. And let that be your guide for trading it. Right. Anything else? For anything else, I'm going to call it a day for today. And I think K-Man might be back tomorrow if he's all fit and well. If not, it'll just be me. It's going to be a half day tomorrow for some US markets going into the Good Friday weekend. Okay, so just to let you know that we might be seeing a bit lower volatility, liquidity coming in. Also, still keep an eye on those fixes. Watch the clock every hour, going through to the London fix at 4 o'clock today, just in case you start to see further moves for end of month stuff. So if you get to the top of an hour and you suddenly see euro dollar moving 10-20 pips where it hasn't moved 5 pips for the last hour, you know it's going to be it's likely going to be fix related, end of month related. And on that note, thank you very much for coming to the Flow Show. I hope you enjoyed it. Keep an eye on those Japanese comments as well, and we shall catch you all up tomorrow. Have a good one, traders.